He's a loan officer in Inlanta Mortgage. Previous types of jobs are advertising and sales. He has 2 children, 1 son. He's, how old is he?
My son is 43.
Oh, okay. And a daughter that's 13.
14. Quite a difference. 2 wives there, so it's hell to start over.
And then he has animals. He has 1 golden retriever, and he has many fish. His hobbies are backpacking, hiking, and scuba diving. Activities of interest are explore lots of public lands. City of residence is Wisconsin. Dallas, been there for 28 years. Been in Reedsburg for 6 years. So anywhere between 22 and 28 years he's been in the area. And something that no one knows about him was he was an Eagle Boy Scout. His burning desire is to hike the length of the Cascade. And
Mountains.
yeah, so that means just backpack.
Yep.
He doesn't go with anybody else.
No.
Camps out with the bears and the.
I go every year to the Olympic National Park. It's the prettiest place in the whole world. I want to take the Cascades next. Out of the last 26 years, I've been there for 22 times. So, and I'm going this fall. If you're going to hike in a high elevation, you go in the fall. If you're going to hike in the low elevations, you go in the spring. So, it just has to do with the weather, the mountains. So.
That's wonderful. Key to success is exercise more, eat less, and put your best foot forward. Thank you, success. Thank you.
Alrighty, guys. Mortgage, we always get who and how they came up with it. I came from First Wisconsin, and Inlanta took us over 4 years ago. So I came from First Wisconsin. I still work with the same group from First Wisconsin, but someone else does sign our paychecks now. Inlanta Mortgage, how they got the name, they originally started out in Iowa, but we're based out of Brookfield. We're in 15 states, and when they go to get a web name, try finding one that you can use in all 50 states, and then you can figure out how they got to Inlanta. They could register that in every state, so you don't have to call yourself something different than Illinois is what you would call yourself in Wisconsin. And that's what First Wisconsin, what our biggest trouble was. We couldn't expand into Illinois and Minnesota, even though they're that close, because we had a name of First Wisconsin. It just didn't work. So, but anyhow, Inlanta Mortgage, that's who I'm with. I gave everybody a folder, and I'm just going to cover 3 things. Someone let me know the time as we go through, because I talk fast, I talk a lot, and I lose track of time. We've gone over credit before, but I want just to show this because during our little 1-minute thing, credit got mentioned several times. Real estate agents, insurance agents, credit score not only has to do with what you're going to pay on your mortgage, it's going to have to do with your car loan, interest rate on credit cards, your homeowner's insurance. Why? Why do you think it's so important? Credit scores are usually a good indication on how people handle their life. Alrighty, so we can tell when something catastrophic happens. Someone has excellent credit, boom, cancer, something like that. Credit scores go down. Why? Because of medical bills collections, it's easy to see. Lifestyle change is real hard to change. All right, so when people got ingrained and head to the tavern every Friday, or their driving record isn't very good, it's easy to determine that in credit score. Credit score is simply risk analysis. What's the chance you're going to default? 740 and above, that's where anything above that we consider great credit. The reason being is the chance of foreclosures next to nothing. 620 and below, it's about 1 in 8. All right, so every 20 points in a credit score on a conventional loan, there's going to be a hit to the interest rate. So there's hits just for having a lower credit score. What goes into a credit score, no one ever knows, but it's 35% of it is payment history. Late payments and collections hurt worse than anything. Amount owed on credit cards is the second biggest factor, 30%. What does that mean? If you carry more than 30% of your limit, when you go from month to month, you're affecting your score negatively. It does not mean you're going down. You're just not going up as quick. The higher your balance is on a credit card, the slower you're going to start seeing your credit score increase. Go over your limit once, see what happens. Credit scores plunge, and on credit cards, now we hate them in our business, you go to the default rate. The default rate usually means your interest rate just doubled for the length of the time that you're going to owe that money. So that's a good time to switch cards. New credit. You open a new credit card, you take a hit. You don't take a hit for a mortgage or car loan because they have end dates. You open up a credit card, you take a hit. Why? You can carry that debt right to the grave, and people do. Length of credit history, if something's been on your credit report for a while, it's going to carry more weight than something new. Why? There's a history to it. And then the types of credit used. Usually the department store cards or like household finance or payday loan place or reports to the credit bureau is not going to carry the same weight as Visa, MasterCard, American Express. The reason being is they usually have shorter billing cycles, higher interest rates. So that's everything in the credit score. You can see there's late payments, risk goes up. As the amount owed on credit cards goes up. Let's go to page 2. Risk goes up. 2 credit cards is the perfect number to have. 0 and 8 are just higher risk. Why? With one, there's no history. With too many of them, there's too much chance of catastrophic failure. And then if 5 to 7 credit inquiries in a 1-year time period, if there's a prior bankruptcy, it's 5, otherwise 7 times a year. After that, you will take a hit for every credit score pull. Now, when you do a mortgage or you do a car loan, there's 2 exceptions. A window opens up when you do a mortgage or a car loan. You can shop for a car. Go to 10 different dealers today, have your credit pulled, it's going to count as 1 pull. There's a 45-day window from the first time it's pulled, then it will all count as 1 pull. And why is that? When we do a mortgage, our company alone, you're going to pull the credit on when you pre-qualify someone, alrighty? Credit is pulled to tri-merge report when we submit the loan. However, whatever program we're going to take the loan through, it is submitted. And then again, before closing, we're going to pull the credit again to make sure someone can go out and buy a new Mercedes that changes the numbers that we use to calculate their debt ratio. So that's everything on credit. What we do, that is right here. The other paper is just some unusual ones, but I'm just going to cover the basics. What Inlanta Mortgage does, FHA and FHA 203K loans. I'm going to cover, FHA is the Federal Housing Authority. It is a very good program. It's low down payment, 3.5% down. You don't need much money with FHA. Already, they lend anywhere. They do have county limits depending on which county you're in. All right, most of them are $271,000, $271,050. Those are most counties. All right, that they'll loan up to. So they're going to loan almost everybody in here that would be buying a house. All right, 3.5% down, very attractive. The negative for FHA, another positive. They'll go down to a 620 credit score, and you can still get a good rate. Those are the positives. You got a little bit softer underwriting guidelines, and we can take a lower credit score. Now that is the good part. The bad point to an FHA loan, they are expensive. 1.75% the government's going to take right off the top. All right, now they just changed the rules on FHAs within the last year. Your PMI, private mortgage insurance, is on there for the life of the loan. With any other loan product, when you hit, not every other loan product, conventional loan products, when you pay your mortgage down below 80%, you don't need private mortgage insurance. Private mortgage insurance is just, what it says, it's insurance. It's insurance to the lender that if you default, they're going to get paid. Alrighty, so why don't you need it when you get below 80%? Fannie Mae and Freddie Mac, the government agencies that underwrite most mortgages. Alright, they give everybody a free pass up to 80%. Alright, so if you're written under Fannie Mae or Freddie Mac guidelines, which is a conventional loan, if you default, we're going to get paid back 80%. So the private mortgage insurance covers from 80 to whatever you're borrowing up to, 97.5%, 96%, depending on what we're doing. All right, so that's what FHA is. It's expensive. It has PMI on it for life alone. It does not drop off anymore unless you put more than 10% down, but it's still on there for 11 years. So that's FHA. Conventional loan, at least 5% down, good credit. That's what a conventional loan is geared towards to. We can get private mortgage insurance for a third of what FHA's private mortgage insurance costs. And usually, like I said, 680 credit score above, we can go down to a 640, but every 20 points there's a hit to the rate. You should see the interest rate at 640 credit score on a conventional loan. There is quite a hit for that. But that's what a conventional loan is, at least 5% down, underwritten under Fannie Mae and Freddie Mac guidelines. You got to have 5% down or we can't buy the private mortgage insurance. 203K home path, home style. What these mortgages are is this: we can finance repairs in. Now, usually I do about 2 of these loans per year. I was on one yesterday, I have one Friday, and I have another one on Monday, either a home style or 203K. And let me give you an example of what I did last night. We're doing a purchase of home. The purchase is $216,000 in Belleville. Well, it's not a foreclosure, but the house needs updates. Even though it's only 9 years old, they want a new countertop in the kitchen, all new carpeting, all new flooring, and all new appliances. Well, we're just adding that to the mortgage. They don't need a whole equity line of credit, a second mortgage. They don't need anything else. One mortgage, one closing. We finance all the improvements along with the purchase price. They're bringing 3.5% down on an FHA program. That's a 203K. Home style works the exact same, except for we don't have the county limits. You have Fannie Mae limits, so we don't have a county limit, an FHA at $271,000. We got Fannie Mae's at $417. So when someone wants to do a lot of repairs, I'm going to Chicago. We're taking it right to the $417,000 in Riverside. We're doing the purchase of the home, and she's bringing in the difference. We're financing up to $417. The houses do have to appraise out. That is the main thing. VA, if you're a veteran, you should have a VA loan. Cut, plain, cut, simple and dry. If you're a veteran, you should have a VA loan if you have a mortgage. If you don't, you're paying too much. I can guarantee it. USDA finances 100%. USDA, if you're not a veteran, it's probably the best program out here in this area. Not just because of the 100%, but they have a low interest rate like FHA does. They have expense. There's a 2%, where FHA is 1.7. 5%, USDA is going to take their 2%, but their PMI is low. FHA's private mortgage insurance is 1.35% divided by 12. Well, add that to the interest rate. That's if you got 4.25, now we're talking 5.5 for an interest rate. We're on USDA. It's a figure of 0.4. So I mean, there's quite a difference between 1.35 and 0.4. So I mean, it's a third. The only difference is on USDA, it's on it for the life of the loan, but every year it goes down because it's on the unpaid balance. A very good loan they have is the USDA loan. Owner-occupied only. FHA is the same way, owner-occupied only. So you have to live on it. We do refinance, not often nowadays, but I'm going on one right now where the lady has never refinanced 8 years into a 30-year mortgage. I'm taking her 15-year. All right, her payment's staying about basically the same, but she's at 22 years left. Now we're going down to 15 years, and she's not going to pay any more. In fact, it was actually just a few dollars less. Reverse mortgages, we don't do many of those anymore. The reason being is reverse mortgages. We used to be able to lend 80% on a house. Now it's at 60%. Most people cost on reverse mortgages owe more than 60%, and all we get is tears. But what they are is simply this: it's the exact opposite of mortgage. If you got a house paid for, we're going to come in and hand you 60% of that equity to you, but instead of making a house payment, that interest is just added to what you owe. You live in the house until you die, or you sell the house, and whoever's left, they sell the house and just pay whatever the balance is on a reverse mortgage. It is very good. It's for the people that have money that are trying to just get out of a $1,000 or $2,000 payment a month, but because they have the equity. So yeah, it is a very good program, but most people that call, what ends up happening is they've already refinanced several times, there's no equity left, and there's nothing we can do because they would have to bring a lot of money to close. But it is a very good program. It's very expensive, but if you want to stay in your house, it's the best thing out there. If there's equity, to stay there as long as you live. So someone's 62 and lives to be 102, they might owe more, they may pay more interest than what the house is worth, but you're a non-recourse loan. Whatever it sells for is what gets paid back. So there's no difference that you're going to pass on to anyone else. But that's what reverse mortgage is. Jumbo loans, anything above $417,000. We use mainly Associated Bank for our jumbo products. We do underwrite for Associated Bank also but mainly it's always just jumbo loans or something that falls outside Fannie Mae and Freddie Mac guidelines. Good for self-employed, very good for jumbo loans. Usually the $500,000 or $600,000, you can't beat Associated Bank. That's who we use. Or U.S. Bank wide. They lend their own money, so the rules are what they say they are. Alrighty, so that's what the biggest difference is. And WIDA is the state of Wisconsin. They do offer a program. It's kind of hard to fit people into it. It's a very good program, but it's designed for lower income. But you gotta have good credit. Usually low income and good credit you can't use in the same sentence. But if you can, WIDA is a very good loan there. We can do 100% financing with a WIDA loan. It's done as a 97% first and a 3% or a 5% second that is actually written off if you stay in the house for so long. So it's a very good program for anyone. And even though the low income to them, I think for a single person, it's like $48,000. So it isn't like it's, you know, it's designed, you can still make quite a bit, still qualify for a legal loan. That is the basics for mortgage loans. Does anyone have any questions?
That was a brief snap.
Am I getting 10 minutes yet?
Yeah.
I'm done, got it. Well, you have to save the questions for after the meeting. David Leonard and Inlanta Mortgage. To keep what they have or to go somewhere else, and I'll give them a suggestion. So we're always looking out what's best for the customer. I do have people that need insurance, so I'll be sure to send them your way.